In this video, I'll be detailing exactly how I received my second biggest dividend payment to date this September, as well as my third total dividend amount over the £50 mark. My investment strategy is a simple one. I aim to allocate around 50% of my portfolio into index-based ETFs which mirror the market as a whole. I'll then try to beat the market with the remaining 50% of my portfolio. I may well underperform the market over the long term by investing this way. However, I do genuinely enjoy picking individual stocks, and it does help keep things interesting for me. So without further ado, let's get into the numbers. As always, the information in this video is not meant as financial advice. I'm only sharing my own experiences. In ascending order now, from the lowest to the highest, first off this month, I was paid £3 by the Vanguard S&P 500 ETF, which mirrors the performance of the S&P 500 as a whole. With a dividend of just 1.3%, I'm not expecting much in the way of income from this one. However, the S&P 500's track record for growth speaks for itself. This ETF is currently the only holding within my portfolio that's geared more towards growth than dividend income. VUSA pay their dividend on a quarterly basis. Next is Bluefield Solar Income Fund in the energy sector, which paid me £7 this September. Bluefield's business model is primarily focused on turning power from the sun into cash via solar panels. The simplicity of Bluefield's operation is one of the main things I like about this company. BSIF has not had a great year so far, down around 17%. Despite this decline, I believe that Bluefield's fundamentals remain strong. With a huge dividend of 7.7%, which is also well covered by earnings, I really can't see the price falling too much further, although I have been wrong in the past. HSBC in the financial sector next also paid me £7 this month. Companies within the banking sector tend to have fairly choppy dividend payments. However, HSBC seems to be a bit more stable in comparison. HSBC have a healthy dividend of 5.8%, which is significantly above the index average. In addition to this, HSBC has had a solid year to date, up 13.4%. Next up, it's the iShares Core FTSE 100 ETF, which mirrors the performance of the FTSE 100 index. Unfortunately, the FTSE 100 has returned next to nothing in terms of growth over the past 5 years. However, when you take the dividend payments into account, the average annualized return sits at around 3.8%. ISF pay out quarterly and currently have a dividend of 3.9%. The second biggest payment this month was from the Vanguard All World High Dividend ETF, which paid out £13. This ETF is made up of higher dividend paying stocks from all over the world, as the name suggests. VHYL offers exposure to over 1,850 different companies and currently has a dividend of 3.7%, which is paid out quarterly. On to Legal & General now for the biggest payment this month, coming in at £27. I currently receive more dividend income from Legal & General than from any other company in my portfolio. This is due to Legal & General being my second largest holding behind the Vanguard All World High Dividend ETF, but also due to Legal & General's huge dividend. My yield on cost with Legal & General is around 8.6%, although the current dividend yield is sitting at around 9.5%. A dividend as high as 9.5% can sometimes be a cause for concern for a few reasons. It may simply be that a dividend that high is not well covered by earnings and therefore won't be sustainable. That does not seem to be the case for Legal & General, who currently have a dividend cover of 1.8, which is pretty good. It could also be that the high dividend is a result of a big fall in share price, which should be a cause for concern or at least further investigation, and not a reason to invest based solely on a higher dividend. Legal & General's share price has been slowly grinding lower as of late, but as far as I can tell, this is mostly due to interest rates and inflation remaining higher than predicted, and not due to an internal problem within the company itself. I'm confident the share price will bounce back once the economic outlook improves at some point in the future. On to the monthly dividend tracker now, and you can see that September has been my second best month so far. I can also see that at this rate, it won't be much longer until I have to change the scale of the chart, which is really encouraging to me. I'm now at a point where I'm seeing £50 plus returns on a more regular basis, which also helps to keep me committed to the process over the long term. You really just have to find motivation from wherever you can during these early stages, before the compounding effect really kicks in. This next chart shows my average monthly dividend income. Looking at the average, as opposed to the actual returns, gives me a much clearer picture of where I'm really at. This is my favourite metric to track, not only because of its consistent growth, but because of what it represents. I find it comforting to know that going forward, no matter what else happens in life, I will at least have this amount coming in each month on average. I know it's not much right now, but the figure does become a bit more meaningful each and every month. These are the actual dividend returns I get on each stock that I own, and may differ from the amount you'd get if you purchased today. This is known as yield on cost, and it's dependent on the average price you paid for the stock. The total dividend yield across my portfolio is still sitting at around 4.7%. The current average FTSE 100 dividend is 3.9%. Let's go over to Trading 212 now and make a purchase. Diageo's had a pretty miserable year so far and is down around 13.5%. That being said, Diageo is still one of my favourite stocks due to its solid fundamentals. In addition to this, Diageo is known for having super reliable dividend payments and has also grown their dividend each and every single year for at least the last 24 years. So with that in mind, I'm happy to add more to this holding at this reduced price. Since the current price is lower than the average price I paid for my shares in the past, buying more shares at this lower price will then reduce my average cost. Whenever you reduce your average cost, you will also increase your dividend yield on cost. If you're interested in starting your own portfolio, then check out this playlist to see my own journey from day one and get an idea of how things play out over time with regular monthly contributions. As always, thanks for watching.